The banks have been battling for your business for the past few months by aggressively cutting short-term fixed mortgage rates to the lowest levels seen in decades. But with the prospect of interest rate hikes still some way off, has it been working? With us now is Gareth Vaughan from interest.co.nz. Good morning to you, Gareth.
Good morning.
So we've got the latest data from the Reserve Bank showing the effect of this interest rate war. What does it show us?
It is showing a move back to the fixed term rates. The figures for the month of May show that the percentage by value of people on floating rates fell from a record high of 63% down to 61.7%. Now, that doesn't sound a lot, but when you're talking about a total of 172, 173 billion, it's a fairly significant sum. So I guess the banks are achieving what they wanted. They are getting people to tie into some of those fixed term rates.
And I guess even though those percentage moves are small, it's the first time in a while we've actually seen it change.
Yeah, it is. It's the first time in a month that the floating rate value has fallen since last August.
So could this be the start of something, or is this just because they've been battling so hard to get our business? Are we likely to go back to favouring that fixed term security?
I guess a lot will depend on what happens. I mean, we had a situation for a long time where floating rates were lower than fixed rates. These are the advertised rates. Obviously now we know that a lot of people are getting discounts on advertised rates of up to 50, 60 basis points in some cases. But in terms of the advertised rates, the floating rates were lower for a long time. Now the fixed term rates at 1 and 2 years, for example, are up to 40, 50 basis points lower than the advertised floating rates. So if that situation remains and the banks continue to target the fixed term area, then we could see this continue.
Because I guess the thing in the back of a lot of people's minds is that the Reserve Bank governor keeps telling us that interest rates are probably not going to go anywhere for quite some time. So that must factor into how long you lock in for.
Yeah, look, it does. It sort of all depends on what story you buy. I mean, a lot of people, more people now are sort of buying the story of the world being in a very ugly place, obviously with very high sovereign debt levels in places like Europe and high private debt levels in places like New Zealand, and that it's going to take several years for us to get these under control, and therefore, we've got annualised mortgage growth now of about 1.5% compared to double-digit growth between 03 and 08. It's going to be a long time before we get back anywhere near that. So if you buy that argument, then probably interest rates aren't going anywhere soon, because even though the bank's own funding costs have increased, they don't have to borrow as much money because they're not lending as much.
Because we have seen one bank now cut its 5-year rate pretty severely. Is that where the next battle's going to be?
Well, that's going to be very interesting to watch. That's ASB, who's cut their 5-year to 5.99%, just under 6% this week. The first cut in a while. Most of the action happened in April, May. We've had a bit of a lull, but the figures that have come out this week do show that one of the big areas of growth is in the 3 to 4 year space. So it does seem that some people are saying, hey, look, these are low long-term rates by historic standards. If I lock this in for 3, 4, 5 years, I get a lot of certainty, and under 6% for 5 years, it may tempt some people.
It does sound pretty good. Is there any indication of which bank might be winning the war?
Well, Kiwibank kicked all of this off back in April with a 1-year fixed rate special of 4.99%. Now, they say that they took in over $200 million through that, and about half of that came from other banks' customers. So they're obviously still doing pretty well. They're very aggressive out there. Also, ANZ has been very aggressive and has been gaining some market share of late. And I mean, it's quite an extraordinary time really in the mortgage market, because there's such low overall growth. The growth the banks can really get is by stealing each other's customers. So they're even doing things now like paying paying break fees on fixed-term mortgages to other banks' customers to help win them across, discounts of 50 to 60 basis points on advertised rates, and chucking in at, $2,000, $3,000, $4,000 cash to cover legal fees and valuations and that type of thing. So, if you're a customer, it's a good time to shop around, and there are some good deals to be had.
Thank you very much, Gareth. That is Gareth Vaughan from interest.co.nz, and as he said, I think the consumer is the winner here.